currencies.com. And Jim's going to provide some very important intel today. We're going to talk about the yen carry trade. And I'm not going to attempt to explain this. I think Jim is the one to do it, but he explained to me offline that this is something that basically nobody else is talking about right now, and it has a significant impact on the U.S. financial market. So he's going to break all of that down today. Jim, it is really good to see you. We haven't met, and I think it's a little over a month, so great to have you back on the show, my friend.
Well, it's good to be back. I got to say that when I was a younger guy, I was working as a marketing research analyst at Digital Equipment Corporation. It was the early 80s and then the late 80s. And I read about something and I thought, this is wild. It was around 1990, maybe 91, could be 92. I don't know. I don't care. But it was around 1990. And we began to see the Japanese go to 0%. And that's where the ZIRP, zero interest rate policy, came about, that acronym. And I thought, that's crazy. What are they doing? You can't do 0%. Money must cost something. So I dug into it. And I used to read Barron's more than I read Wall Street Journal. I liked Barron's. I liked a guy named William Pesek, P-E-S-E-K. I thought he was great. He taught me a lot about the bond market. And Jim Grant taught me a lot about the bond market and monetary policy. Here's what I learned, Patrick. The Japanese had a problem. Their problem was too much success. They turned things around in the 1970s with quality control. They brought in a guy named Deming. Deming was rejected by American industry, and he went to Japan and became a god, quality control god. Okay, so Toyotas became really good cars in the 1980s because they turned their quality around. There's a lot of information that I'm going to skip over. But Japan, essentially, in the 1980s, had a success story that caused them a big problem. They became an export industry giant. We had Toyota, we had Honda. Back then there was Nissan. They called them Datsun. Datsun got absorbed by Nissan. There was Honda. Honda didn't even make cars back then. They made motorcycles. They made lawnmowers, stuff like that. We had Nikon cameras, Leica cameras, Nikkei cameras. You had all kinds of things. You had Mitsubishi cars. You had Toshiba computers. You had a lot of different little computers that competed in the PC market. Okay, here's the big problem. They had so much export surplus that their currency was rising, and it rose too much. And remember, always remember, Japan is on a short lease from Wall Street and the U.S. government. They are a vassal state, along with Germany, the losers of World War II, or so we're told.
So we're told.
So we're told. There's a lot going on behind the scenes. We won't get into that. But Japan appealed to the United States and said, what are we going to do? We got too strong a currency. So the United States said, why don't you start spending money like lunatics with construction projects, roads to nowhere, bridges to nowhere, ports that aren't used, highways that, kind of like the Chinese empty cities, but Japan invented that. They had roads to nowhere. And there weren't even controversies about where is this going. It said, well, it's a road to nowhere. Don't worry about it. We're making jobs. What they were doing is they were producing deficits. And now Japan has a bigger deficit compared to their GDP than the United States does. Okay, at the same time, the United States had a real big epiphany. Why don't we drive down your interest rates? Okay, little known to a lot of novice financial types is that the currency is largely a function of the interest rate for the country that owns the currency. Yeah. Every time they raise interest rates for the dollar, for the Fed, the dollar has a rally. Every time they lower the rates, you get a bond rally, but you get the dollar going the other way, going down. Okay, it's so basic, and I got stories about that. One I had a disagreement with Rick Rule of Sprott, and he's a great guy, and he's a brilliant guy, and he's very friendly, and he was nice to me in my early years. But I had a disagreement with him. I told him the United States is lowering interest rates. No, what was it? He said, oh gosh, I don't want to get into the dispute because it involved interest rates and deficits. And I was relying on the argument that if you lower interest rates, you're going to lower the dollar value. Okay, so here's the crux of the matter. The United States Wall Street bankers said to Japan, why don't you go down toward 0%? That'll eliminate your strong currency. So they did. And Wall Street stepped in and began, I hear 2 trillion, okay? 2 trillion was borrowed over numerous years, borrowed from the Bank of Japan at near 0% and invested in the United States Treasury bonds.
Now, did the U.S. sort of coerce them as a vassal?
Yes.
This is something they didn't really want to do.
I don't think they wanted to do it. I thought they realized, I think, it's my opinion, they realized that that's a disastrous policy if kept for multiple years.
Yeah.
But once the Wall Street crew got in there with, I just call it the $2 trillion yen carry trade. And back then, we're talking about 1990 decade. So we're talking about, 5, 6, 7% long bond and maybe 0 or 1% Japanese borrow. So you got a 6% delta. They call it the VIG.
Yeah.
The delta is 6%. And if you let's not put leverage on it, okay? I mean, if you put futures leverage on it, you can amplify it by 20-fold. And obviously it's what they did, okay?
Of course.
It's what they did, and they always claim, well, we know how to do this. This is our science. We have the brain power. We have the computers. We have the models. We have experience. Okay, so let's just say they were making 100%. Okay, leverage off 5 or 6, 20-fold is 100%. They're making 100% on a $2 trillion trade. Now, for those who think these are wild numbers, you're dead wrong. They're actual numbers. They're actual numbers. Wall Street was earning hundreds of billions of dollars on the yen carry trade, and it never went away. So now.
So just to specify really quickly, and then I'll let you continue.
Yeah.
The carry trade, the basic principle is to borrow against. Can you just explain the basic principle? I don't want to mess it up. Just
you borrow at 0% money, and you invest on 6% return in the
and you
treasury
capture
bond.
and you capture that VIG like you were talking about.
And you try to make sure that the currencies don't swing.
Right.
But they
are.
are.
That's the risk. That's the risk.
They are.
That now they are. Got you. Okay. Continue. Go ahead.
Okay. Now you have a discount on what they borrowed because the yen has gone down 20%. The yen has gone down 25%. So the yen carry trade is making a lot of money and is presenting a climax for the Wall Street managers of the yen carry trade. Now, there are a lot of mysterious parts to this, and I can't say that I've got it all figured out. I got the rudimentary parts. Right now, Wall Street is thinking Japan is starting to raise interest rates. Japan is abandoning the treasury bond. They're selling treasury bonds. They're raising interest rates. They are buying gold. They're causing a problem in the gold market along with China. We need to close out the yen carry trade. So they need to pay back Japan. And remember, in the news we've had in the last week that the Federal Reserve is entertaining the notion of supporting Japan for assisting with their currency. How do you do that? You buy back on the yen carry trade. You see? That's where it figures in. Now, I heard a couple of analysts make a comment in the last week, just the last week, that a disaster is building now in Japan, and it's going to spread to the U.S. financial markets. Let's just say Wall Street banks. There's a disaster building in the Japanese financial system. Mm-hmm. Could it be the end of the yen carry trade with the Wall Street bankers buying back, closing out their yen borrowing, and lifting the yen? Okay, they need a lift in the yen. They're going to be asking Wall Street, pay back on the yen loans for your yen carry trade. Pay back the $2 trillion. Even if it's $1.5 trillion, it's a big amount of yen to pay back. Now, that's only half the story. What's the other half? They have to sell the treasuries. The Wall Street crew has to sell the treasuries. Okay, I do not believe that locked in the $740 billion of unrealized, let's just call it bank asset losses. Mm-hmm. They're treasuries. Come on, get real. Mm-hmm. I do not believe that it includes the yen carry trade.
Oh.
Okay. Another $2 trillion on the table, losing money. Okay. Now, when they put on the yen carry trade, they roll that over. You don't just hold that from 1995. You roll it over to the prevailing rate. Well, what was the prevailing rate in the last 7, 8, 9 years? 2.5%, 3% on the long bond. Okay. My point is that the other side of the yen carry trade is a disaster for Wall Street. Closing out the yen carry trade and selling treasuries that they were earning 6% over their borrowing rate in Japan. Mm. Okay. Wow. Why doesn't Wall Street do it? Because it starts what's called the convexity principle. Once it begins, they lose control. If one or two Wall Street banks, okay, I made this point a month ago and 2 months ago, that if one or two big Wall Street banks start selling treasuries, the bond yield is going to go up, their losses will increase, and it'll encourage the other big banks to sell. And before you know it, they lose control. We're up at 7% on the long bond, and it could go higher. It could go 8%. It could go 10% if they lose total control. Mm-hmm. Now, add to the mix, closing out the Wall Street yen carry trade with $2 trillion on the table, borrowed from Japan and managed all these years. We're talking about almost 30 years. Mm-hmm. Okay, I believe that has produced off-balance sheet profit for Wall Street. What have they done with that profit? I believe they've been buying gold. I believe they've been buying gold for the last 10 years. I did a consult call, and I got to be careful with my description. I did a consult call several months ago with a fellow, and I'm not going to describe him, except to say that he was doing consulting work, financial planning, and accounting work for a couple of Wall Street banks. And he said, Jim, you need to know this. They all have significant gold reserves. Every Wall Street bank has significant gold reserves off balance sheet. They've been accumulating year after year after year. I believe they've been using the yen carry trade to provide some of the profit for that. Now they need to deal with any, you can't dance around this. We're going to have a Treasury bond default. We're going to have a U.S. government bond default. We're going to have a U.S. government debt default. Now, remember, Trump has made a couple of indications just in the last 2 months. Trump has said one of my first orders of business is going to be to manage the U.S. government debt default. Right? Mm-hmm. Now, you can't do that without a bond market default.
That's right.
And a bond market default is happening under our noses. I believe that it's a 2, 3, 4 year process. I believe the foreigners are now taking a haircut on bonds that they're selling. They're not getting 100 cents on the dollar. Okay, they're taking a loss just from the higher interest rates in the last 2 years. I believe they're taking an additional loss by taking the funds in their domestic currency. Now, let me make a point apart from the yen carry trade. There's a lot of buzz out there, and it is wrong buzz. The wrong buzz is saying that foreigners are selling treasury bonds and the money is going to come back to the United States and cause inflation. Well, that's just dead wrong. If France or Norway or Saudi Arabia or UAE or other countries are selling treasury bonds, they're taking their domestic currency in their own banks. It's not coming to the United States.
Right.
The risk for price inflation in the United States is no buyers of our current operating deficits that we monetize. And we're going to see, I think we're going to see 2021 type price inflation again. I mean like 12, 13, 14, 15%. This is just me. I'm stubborn, Patrick. I don't look at what the government says is their price inflation. I just know that it's always around 3, 4, 6%. Okay, and it's all designed and gimmicked and bullshit. I don't pay attention.
So you're saying that the stories that we're hearing about bonds being related to inflation, the Treasury bond crisis, really, that's not the real story. You're saying
No. Don't get me wrong. Foreigners selling Treasury bonds does not bring money back to the United States to cause inflation.
To inflation in that way.
It's the United States government deficits that we monetize. We cannot sell securitized bonds in the volume necessary. So we have to print money to cover it. And that is the source.
I get you. Okay.
Of our price inflation.
Right, so it's not so much them dumping the Treasury bonds, it's the fact that they can't sell any new ones.
We can't sell any new ones, and we can't find any buyers for those that are being refunded. I don't like that word. The maturing. And we got $10 trillion this year of maturing treasuries. $8 trillion in long maturity and $2 trillion in short maturity.
Right.
That's hard to describe because I don't like the word refunding. We need to find funding. We must find funding for $10 trillion in maturing treasuries. Okay, remember, there was a few weeks ago that we had what was called a successful treasury bond auction. It was a joke. It was an effing joke. They said they had a $25 billion successful treasury bond auction. And I say, what about the other $970 billion for that month? Because it's $1 trillion a month.
Mm-hmm.
$25 billion, they talk about, okay. I don't want to belabor the point, but we got a lot of maturing treasuries that we cannot find adequate bond investors to bid on. We have a very critically low bond bid for treasuries. And I'm just going to say it. I believe the Exchange Stabilization Fund is grabbing a lot of the excess treasuries that no one wants to buy.
Mm-hmm.
And I don't want to stress the Exchange Stabilization Fund because it is a $10 to $15 trillion slush fund used to rig financial markets. It's kind of a wild card, and let's leave it alone, but put it on the shelf. We cannot find adequate funding for all the maturing U.S. treasuries this calendar year. We're going to be using the ESF and the printing press. I believe the ESF is going to manage the refunding for foreign holders, and I believe that the monetary press, printing money, is going to manage the new debt. That if we're creating an additional trillion every 100 days, then you cannot, with a straight face, say we're going to have a $2 trillion deficit. You have to make it bigger than 3, or else you look stupid that you can't extrapolate. If it's $1 trillion in 100 days, what is it for 360? It's going to be over 3 trillion. I'm just saying it's like 3.25, 3.4 trillion. Okay, we're now at the point where the interest rate, the interest cost, the borrowing cost is over 1.2 trillion annualized now. We're doing 100 billion a month in borrowing costs. Why do I drive this point home? We're going to have a bond crisis. It's going to have some impetus from the yen carry trade. It's going to have some impetus from U.S. big banks that cannot manage their underwater portfolios. It's going to be also big banks that have to buy back from the bank term funding program. Remember that waiting room for bankruptcy?
Yes.
Well, it got closed down in March. Okay, we're now more than 2 months into that. Mm-hmm. They've got to buy back all those assets where they were given book value. Now, let me give you a quick lesson. If you've got, say, $10 billion in assets, book value that you borrowed, and you can only sell them for $7 billion on the open market, you're in the hole $3 billion on wiping out that account, nullifying, expunging that account. The big banks are in so much trouble, it is not even possible to quantify. Okay, they're also in trouble with their gold shorts and their silver shorts. I like the description that the banks are in a very vulnerable position with their gold short contract portfolios, and silver is the fuse. They cannot stop silver. I got some quick notes here. These are just quick notes to point out how out of control it is. London has 30 times less silver in their vaults than they do gold. What's another one? The open interest for silver alone is on the order of 8 times the annual production of silver. About 8 times. This is out of control. The daily trade volume for gold is about 200 million ounces. The daily trade for silver is almost 3 billion ounces. We're going to run out of silver. Now remember that little harlot, Janet Yellen, she went over to China and she asked them to make fewer electric cars and to import less silver. And they basically said F you, patted her on the head and pointed out that in a couple of days it's time for her to leave. There is so much going on with the arbitrage. And I mentioned the biggest arbitrage in modern history, the yen carry trade, $2 trillion. Now there's another arbitrage, and this is far more complicated and insidious. Can I switch over to
We're
Switzerland?
Talk about Switzerland, yeah, okay. Mm-hmm.
Okay.
Just to sort of sum up what you've been saying so far. So $10 trillion is what we're looking at in terms of maturity yields this year that they're on the hook for. And then on top of that, we're talking about this arbitrage having to do with the yen carry trade at an additional 2 trillion. So that brings us up to
not adding that. Well, wait, be careful with the words.
Okay.
Wall Street is likely to close out close to 2 trillion in treasuries purchased from borrowed Japanese money 30 years ago and rolled over and rolled over and rolled over. If you're still making money on it, you don't close it out.
Right.
We're talking about hundreds of billions each year in profit.
And you also mentioned, not to get back into it, but you also mentioned the ESF is sort of the counterbalance to everything that's happening behind the scenes that's keeping them propped up. And your estimation is it could be up to 15 trillion. So we're getting dangerously close there to that breaking point. I think that's sort of where you're.
I think so, Patrick.
Okay.
Imagine that if the ESF has 15 trillion, mostly in treasury bonds, imagine the borrowing capacity. Well, they can put, up on collateral 2 trillion and manage all of the foreign expected purchases that does not happen for the current deficit, the current year. Okay, when you got 15 trillion in slush fund, you can do a lot of things.
So 10, yeah.
Okay, let's leave alone the ESF. I'd like to really leave it alone.
All right, so
it gives
switching
me
over to
a
Switzerland.
shrill. Yeah, okay, Switzerland.
Yeah.
Okay, now there are a lot of people, including you, because you were just a younger man in 2011 and 12.
I was just waking up around that time, really.
Yeah. Well, I was 9 years into my newsletter. Okay, I was not a young pup. And back then, we were on the tail end of the pigs' debt crisis. Portugal, Italy, Greece, and Spain. They all started to see their interest rates go up toward 8 to 10%. Now, on the back end of that, around 2011, there were a lot of people who thought, well, you know, the pigs nations in Europe did not fix anything. So there was an exodus out of the euro. Now, if you're an Italian, or you're a Frenchman, or you're a Belgian, or you're a German, or you're in Liechtenstein, and you're holding euros, you're going to want to trade it for something that you're familiar with. So what's your safe haven? It's Switzerland. A lot of Europeans dumped their euros and bought Swiss francs. And it caused a problem in 2011. The Swiss franc went up too much. Now, for those who don't know, in the United States, it is appalling to me how little Americans know about foreign countries. It is appalling to me how little Americans know about what the dollar is in foreign trade, in Forex central bank savings accounts. They're dumber than rocks, okay? And it's appalling. So the Europeans were thinking, I'm just extrapolating on the thought process. Hey, let's keep it in Europe. Let's sell our euros. We live in Italy. Let's sell our euros. We live in Belgium. Let's sell our euros. Let's buy Swiss francs. So they did. And the Swiss central bank had a reaction. They said, we're going to maintain a 120 euro peg for Swiss francs, the Swiss currency, not to be confused with the French franc. I don't know why they have the same name. Not important. But they maintained a 120 peg for the euro. They called it the Swiss euro peg. And what it meant was that the Swiss central bank bought hundreds of billions of dollars in euros. Okay?
Mm-hmm.
So they bought the euro and essentially they sold the Swiss franc. They brought it back down to where they wanted. And that's the Swiss euro carry trade.
Okay.
Now, this gets complicated. I've explained this before, but I think now it's going to maybe come to a head. And I'll explain why.
So it's the same basic principle, but you're about to add the complexity. So it's the same basic, the carry trade that we talked about with Japan, the same basic principle of what happened with the Swiss franc and the euro, but it gets more complicated.
Yeah, but they didn't have an interest rate differential.
Okay, so all right, so there's the difference then.
What they were basically doing is they were preventing the Swiss currency from going up too much. And they were going to just stockpile euros. And I don't want to get into the issue of euro bonds versus Swiss bonds, because the Swiss actually have a low interest rate. It's not a critical part to my argument. I'd prefer to leave it alone.
Sure. Yeah.
The Swiss central bank bought up. They were the Hoover. They were they lapped up the discharged, rejected euros.
Yep.
Okay. Mm-hmm. And in doing so, they enabled a little sell-off of the Swiss, and they got it back down to 120. It got up, I think it got up to about 135. Okay, for those who don't, okay, this is the other end of my insult to Americans. The Swiss have a very balanced economy. They have pharmaceuticals. They have technology. They have weapons making. They have clocks. They have cheese. They have wine. They have a very balanced economy and an export trade. So they were facing annihilation of their export trade. No one was going to buy Swiss cheese. They were going to buy French cheese, Italian cheese. No one was going to buy their watches. They were going to buy Japanese watches. There was a threat to the Swiss economy. Now, here's where it gets complicated. In 2012, check the chart. We hit 1900 gold. And we went down for a solid decade. I call it the hibernation decade. We went down quickly to 1600, then 1500, and it stayed there year after year. I lost a bunch of clients, Patrick. My peak was 2015. I went down from there. 2016, 17, 18, I got the same complaint. The gold market is dead. Can't play this anymore. I'm getting old. I'm backing out of the newsletter. Good luck to you, Jim. You do good work. All the blah, 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 blah. Okay. So in 2015 or 16, the Swiss Central Bank had a disclosure that they were owners of a tremendous amount of U.S. stocks, and they were basically the FANGs. The FANGs. Facebook, Apple, Netflix, and Google. And back then, I believe the primary emphasis was Apple and Google.
Mm-hmm.
And I asked the question, did they use euros to buy it? And the answer was not clear because gold went down. And I heard from my best colleagues, they told me, Jim, got news for you. For the last few years, the Swiss have been involved in a buy dollar stock, sell gold trade that paralleled the Wall Street buy equity, sell gold. It's the same thing. The Swiss did the same thing, but they bought the FANG stocks, Facebook, Apple, Netflix, Google. And then it became clear this was something that I did not believe that the Swiss National Bank, that's the name of their central bank, Swiss National Bank. I did not believe that they wanted to disclose that they owned $1 trillion or $1.5 trillion of American stocks, and their biggest holding was Apple. I do not believe they wanted that to be known. Then we started to do the math and realize that they're purchasing.
Because of how they purchased it? Is that what you were implying there?
No. It's a number of things, Patrick. Why is the Swiss Central Bank, why are they buying U.S. stocks? Why?
I see. So they didn't want to expose.
What's their purpose? What's their vested interest? What are they doing? They were joining the Wall Street buy stock, sell gold strategy.
I got you. Okay.
Yep. And they were responsible. It became known by 2016 and 17 that the Swiss Central Bank was responsible for bringing down the gold price from 1900 down to 1400, where it hibernated for several years.
Gotcha.
At the same time, the volume of their U.S. stock portfolio was out of line for what they were doing with the gold market. And my suspicion was they were using narco money laundering funds.
Okay.
Now, fast forward, I'm going to just put a little addendum here. The Russians called the Chinese and said the Swiss banks are seizing or freezing Russian assets. So they called the Chinese and said, do us a favor, call up the Arabs in UAE and tell them to pull their $10 billion bid on the Credit Suisse emergency bond offering. It failed, and Credit Suisse entered failure, and they've never gotten out of the problem since. And the Swiss parliament refused to put up something like 10 or 20 billion euros. Maybe, no, I think it was 100 billion euros. It was a large swath of euros. And Credit Suisse has not gotten out of their hot water. Okay, back to the Swiss and the four-sided trade. Notice now that it's a four-sided carry trade. Buy the euro, sell the Swiss. Buy U.S. stocks, sell gold. When you unwind a carry trade, what goes up is what you were suppressing. They were suppressing the Swiss currency. Now it's going to go up. They were suppressing gold, and now it's going to go up. Wow. I believe some of the biggest buyers right now are Swiss banks pushing up the gold price. Okay, who has got that on their radar? Swiss banks buying up gold. They're closing out their short positions. I believe, Patrick, I'm just going to say it. I believe Basel is going to go long gold and long silver. They're not going to get in the way of this locomotive. They're not going to get run. This is not a truck convoy. This is a gigantic locomotive train with 200 or 400 cars on it, and it will not stop if Basel gets in the way. What we've got now is a massive short position in silver by Bank of America. That's my candidate for bank failure. They've got a massive short silver position. They're doubling down. They're on the wrong side, and instead of covering, they're doubling down. They're doing the same thing that Janet Yellen did. They're buying a month, and they're assuring their death in 3 to 6 months. Okay,
kind of makes you wonder who's pulling the strings behind them. If they're making those types of moves that are basically.
King made a point that confirmed some of my. They're more than suspicion. It's more like evidence is just flowing like a slow-moving river. I believe it was 2019 that the Federal Reserve contract ended. I believe it was 2020 and 2021 oh no, wait a minute, I got that wrong. I think it was 2017, the Federal Reserve contract ended, and before Trump was out of office, he integrated the Federal Reserve and rolled it under the Department of Treasury because there was no contract in force. Mm-hmm. It was long before the 2020 election. I believe the Fed contract ended in, well, you know, all you got to do is look at the 100-year contract from 1915 or so. They extended it. Anyway, I don't want to get caught up in the actual dates, but
that's interesting
because I'm not in command of those dates. There are too many numbers running around.
Okay. So you're saying it was well before the CARES Act in 2020. That's the story that a lot of folks have been sort of subscribing to, that during the height of COVID with the CARES Act, with Mnuchin used I think they're called special purpose vehicles to roll the Fed under the control of the Treasury. But you're saying it happened actually back in 2017 with the contract expiration.
Exactly.
Okay.
And if you look at actions by the Fed, they're not really constructive toward Wall Street banks. Now you could say the CARES Act, what was that? That's the two-time feature, the $5 trillion and the $4 trillion for with a non-disclosure agreement for the Wall Street banks to offset their losses from the illicit economic lockdown. I will never call it a lockdown without using the word illicit. Which the bankers control, made the CARES Act to offer the $9 trillion to the bankers. Okay, the Fed, I believe, is under control by the White Alliance. They raised interest rates, which rendered Wall Street banks insolvent. I believe that the White Alliance ordered the Wall Street banks, you must follow this path. At the end of the road, it's your insolvency and destruction, but there'll be a new chapter. And I think the White Alliance is well aware that the Wall Street banks own a lot of gold. They're not going to be left out in the cold. I believe that the Wall Street banks not only own a lot of gold, but the Fed and many, many central banks that are insolvent now are going to get out of their insolvent position by loading up on gold off balance sheet and ordering and facilitating a 3,000, then a 5,000, and later a 10,000 gold price. That's not going to figure in. Silver is not going to figure in that plan. Silver is going to figure in a very different plan of rebuilding and reconstructing the economy using Tesla and other engineering patents. But okay, I want to make reference to something that's really important to me. I do not believe that there's two parts. One has to do with default, and the other has to do with the gold rally. I have not said that this June, July, now we're in June. I have not said in June, July, we're going to have a bond default. I have not said that. I've said we're going to have a debate about whether we're in a bond default.
I remember that. Yeah.
We're going to have discussion. And I've heard misquoting of what I've said. I did not say we're going to have a bond default. Oh, Jim, really think we're going to have a bond default in June? No, I did not. We're going to have a debate on whether we're in that situation.
I recall that conversation. We've had that conversation. You've talked about the haircuts, and there's a point to be made there as to whether or not you're actually already in one when they're having to take a hit.
I think we're 2 years into the bond default, and we have another year to go. But that's a different argument to make, a different discussion. Let's not get caught up in that. All right. The second point, and we're starting to see it. We're starting to see the bond market is rising on the bond yield. There's pressure on the stock market. There's a lot of complaints that, where's the rate cut? I thought we were going to have a rate cut in February. Where's the rate cut? Where's the rate? Okay, we're not going to have a rate cut. We're going to bounce around from the arguments like, well, we still see price inflation, therefore we cannot do a rate cut. And then later, well, we still see a weak economy in the labor market. We cannot do a rate hike. We can't do a rate cut. We can't do a rate hike. This is my argument, Patrick, that we're caught in an inflationary depression. With the inflation, we cannot lower rates. With the depression, we cannot raise rates. So we're going to waver around playing a pendulum game. Well, we're going to cut rates. Maybe we might actually have to raise. We're going to cut rates. No, we might actually have. And we're going to just do this. We've been doing it now for 3 months. I've been saying this for 3 months. We're going to dilly-dally and not do anything. If anything, we do a rate hike. Okay, fine. The big point I want to make regarding the gold market is don't sell the pullbacks. Okay, we had a pullback from like 2350 to 22, I don't know, 2250, 2360, 2380 to 2250, 2270. It bounces around. Okay, so we sold off 100, 130 points. Big effing deal. What it does is it offers China and India a discount because they're the big buyers. China, Japan, and India are the big buyers. The East is controlling the gold market. Okay, here's my big forecast. And this is not, I'm not trying to make a big ballyhoo out of it. We got a 3-year gold rally. It started in the end of 2023. It's going to go into 2026. If you are upset that there's a 5 or 10% pullback, then you are not a very good student of the dynamics. Because I wrote a public article. It was on Gold Seek, and Kitco did not publish it, and Gold Eagle did not publish it. I gave them a chance, but they didn't even respond. They didn't even respond. But Gold Seek, that editor is my buddy. He's my buddy. And he published it right away. I had 20 reasons for the gold breakout. Now, the 3 obvious reasons: price inflation, credit crisis, and the specter of war. And I said, well, we got 17 others. We got banks that are in trouble. We have central banks that are insolvent. We have personal investors who want to trade out of their bank accounts and get into gold and silver, and trade out of their IRAs and 401ks and get into gold and silver. I got 30 or 40 clients that done that. We got central banks all across the Eastern nations, the BRICS unions. They're selling their treasury bonds and they're buying gold. We got the biggest transfer of wealth in a century. It's going to be trillions of dollars, mostly treasury bonds. that are going to go into gold. We have UAE that is in a very quiet war. UAE, United Arab Emirates, they're like cousins to the Saudis. They're in a very small war, Patrick, because they have offered to be the window for dumping treasuries for the BRICS nations.
Yeah, I remember.
They're also involved heavily in crypto. They invested $250 million in crypto channels and infrastructure. When you get the blockchain platform integrated with Shanghai, it's going to connect with Dubai in the United Arab Emirates. And I believe they're going to use XRP. I still think XRP is going to go way over $100. Way over $100. Okay, the gold rally is not going to be brief. We're not going to stop at 2,500. If we get to 2,500 in the next month, which I think we will, June, July, we'll get to 2,500. It won't even be hard. We won't even break a sweat. We're going to, at the same time, probably break 40 in silver and threaten 50 quickly. I think before the leaves fall in autumn, I think we'll see 2,500 gold and maybe $50 silver. Okay, Michael Oliver is a guy with far more experience and expertise than me, and he's saying $50 silver before the elections. Okay, a lot of people think we're not going to have elections. I think we are. A lot of people think we're going to have more and more chaos and disruptions. I think we'll have some, yeah, but I don't think it's going to be sufficient to call off the election and to declare martial law in any way, shape, or form. I think Trump is largely going to run unopposed. And I don't think she'd want to step in. So the Biden mass is going to try to drop out and not be permitted and be held up on the left side, held up on the right side. Yeah, I'm in the Democrat convention. Vote for me. We still have the best fraud operations in place. Okay.
Can I ask you one question about just the election? Give you a little breather there. So,
sure, I'm getting a little tired anyway.
No, I figure you need a little sip of water there. But okay, so elections it's a great topic. We don't have to delve into it too much, but I just really quickly, do you think that at some point, because you said that you don't think martial law is going to be necessary, do you think that at some point, given the close to 500,000 sealed indictments that there are right now, and then the myriad of other issues in terms of disclosure, do you think at some point, even if we see the election go forward, we see Trump come back, do you think at some point they have to flip that switch in order to disclose everything that's been going on and make all of these mass arrests? I mean, how do you see that?
Flip the switch for what? Military rule and emergency broadcast? For
the EBS.
Emergency broadcast. I did want to be clear. Emergency broadcast.
Yes.
Let it be known who the traitors are. Well, we might get that done with Ivan Raiklin, the ex-Beret who's now an attorney. He claims he has the goods on 350 people in the deep state, and he wants Twitter, with permission by Elon Musk, to do a Twitter files on the 350 people. He wants to have deputized several thousand people in 50 states to do arrests. Okay, to answer your question in simple form, I think we're going to get to the point where the mainstream news before the election it's not going to be taken over in any overt form. I think it's going to be a transition, because I've already seen a few stories. There have been on mainstream news some stories about Biden. Is that Biden with a mask? Well, let's have a guest who can talk about. They're bringing up a lot of controversial topics.
Oh yeah.
And I think it's going to accelerate, so that by the time we get to October, we might have a lot of different stories on the mainstream news where emergency broadcast won't be necessary. But I believe the emergency broadcast is necessary. I'm not saying we're going to get there. I'm saying it is necessary. We need some form of publicity, disclosure, exposure, And the Twitter files would be a great way to do that with Ivan Raiklin. And the guy is just fearless and said, Jim, I am Pakistani. I have a degree from the University of Pittsburgh in computer science. I'm a database expert. I am working with you on your project right now. I want to show you the Pakistani news. It's in Urdu. Urdu has the Arabic alphabet with different accents, much like the Czech language has our alphabet with Czech accents, or Spanish or French with accents. He said, this is Urdu, Jim. I speak Urdu. It's my native language. And he was fluent in English. Great guy. His name was Ahmad, like 100 million other Arabs. Anyway, he's not Arab. He was Pakistani. Big difference. Big difference. He's West Asian Muslim. Failed. There it is.
Yep.
Okay. That's my friend Ahmad. I lost track of Ahmad because I lost my job there. I lost my job and I started a newsletter. I had no idea what would happen in 2004 with a newsletter. Patrick, my first goal was to manage and survive my monthly expenses. Mm-hmm. You know, like $1,000 a month or $1,200 a month, and living like a pauper, not doing anything, no fun at all, no fun. But I did a little fun on a credit card. Anyway, that's another story. Then my second goal was, I sure would like to make my previous salary. That'd be cool. And then I had more ambitious goals, but now it's a very successful newsletter, and I'm very surprised. Okay, the message I have for people is hang on and do not sell out of gold and silver with pullbacks. They want you. They're going to try to do, they're still doing some naked shorts, and they're going to get in more and more trouble. We are about to see exchange traded funds, the ETFs. Okay, this has come out now in recent news. ETFs have been, what do you call it? They've been hedging their long positions by shorting gold in the ETFs. Mm-hmm. And they're going to get trapped. And these ETFs are going to blow up. And I'm hoping that it's the Swiss and the London bankers with SLV and GLD. GLD, what's that? The SPDR Gold Trust. It's going to blow up. It's going to just explode. They're going to go quiet. They're going to say, we don't know. We don't have any more records on what our vault holdings are, because they don't have anything. They're going to say, we're shutting down the fund. We're not taking new investors. Why? Because you're broke and you're bust. You're going to go bankrupt. You have lawsuits. Okay, SLV and what's the other one? GLD, they're going to go bust. The exchange traded funds are going to be the first visible victims. But I think we're going to see Bank of America go bust. We're going to see the Wall Street banks show up. A lot of losses for quarterly, what do you call it, resolution of some of their futures contracts in the precious metal arena. It's going to be very exciting. Let me make another wild forecast. We're going to have some multi-dollar up days in silver soon. I'll give you an example. I'll just make up something. We're sitting at 34. It's June 10th. And in 3 days, we're at 48. We're at 46.
Multiple.
And we have no idea what happened. What was that all about? It's the failure of ETFs covering their shorts, accepting a loss, and it was a big loss. And if they didn't do that big loss, Patrick, it would have been double down the road. Okay, they're going to have to swallow their losses. Okay, if you see a pullback, let's suppose we go up to 37 in silver and come back down to 34. Buy. Okay, right now, I just got news yesterday. In Europe, the European Union, the financial regulators of the European Union just made prohibited any buy orders of Sprott gold and silver ETFs. Sprott PSLV, their exchange traded fund with real metal, SLV for silver, okay. PSLV and their exchange traded fund with real gold, PHYS, the first 4 letters of physical. Okay. In Europe, you can only sell. You cannot buy now. They are panicking.
Wow.
Anytime you block purchase of something, and there are hundreds of other places that you can buy it.
That's
well,
great.
Yeah. What are they going to do? Well, they're not going to buy PHYS in Europe. They're going to buy Swiss PAMPs. You know, the 10-ounce bars. The PAMPs are beautiful. They're a work of art in addition to being a good investment. You notice that Costco had $200 million worth of gold items. Those were PAMPs. It's PAMP. I think it's product. Oh gosh, what's the A? Can't think of what the A is. Metal precious. Product application precious metal. PAMP. It's French. Produit application métal produit. No, métal précieux, precious, précieux. IEUX. It's précieux. Okay, I actually got, when I was a freshman in high school, I got compliments from my teacher. James, you have the best French accent in the class. Congratulations.
That's pretty good, I have to say. That was
Produit précieux.
Not bad.
All right. Anyway, but now I'm all immersed in Spanish.
Yeah. Well, you have to be.
In metal precioso.
Yeah. Good old Costa Rica.
Producto aplicaciones metal precioso. I call my sweetheart Preciosa. Hola, Preciosa.
I remember one show you were telling a story about how you were having an argument with somebody in Spanish, I think at the bank or something, and it was just hilarious. I don't remember what it was, but you were like yelling in Spanish, and I was like, this is just classic Jim.
I tell you, I insult people in Spanish. I got pretty good at it.
Yeah.
Tú eres imbécil. You're an imbecile.
I actually picked up on that one.
Well, here's one of my favorite. ¿Para qué tu mascarilla? ¿Es por esclavitud o ignorancia? Why do you have a mask on? Is it for ignorance or slavery?
Okay.
I got shot down. I have to be careful with that. A really nice looking guy was the guard for a supermarket. And I gave him a funny look because he had a mask on. I gave him a funny look, and he looked back at me like, what are you looking at me for? And I looked at him again and said, ¿Para qué mascarilla? Why a mask? And he said, cirugía. Surgery. And then he lowered the mask and showed that his upper lip had surgery from a motorcycle accident. I said, oh, no, it's ignorancia. No, it's esclavitud. It's cirugía. And he said, sí. Anyway, it gets funny because they don't expect gringos to speak Spanish. They don't. They think most of them are drunk and stupid. And they're right.
All right, let me ask you this, because I know there were a couple other things we wanted to cover today.
Go ahead. Let's do some quick shots.
Yeah, let's do some quick shots. How about, what are your thoughts on, I mean, you mentioned crypto a little while ago, and I've been kind of curious why Trump all of a sudden seems to be doing an about face on crypto, talking about Bitcoin being a good thing. And, it's almost like, he had a long history of being very critical of it. And I'm wondering if you had any insights into, what could be going on with that.
I can only say that when you're about to become the winner, you had better embrace the consensus where you've made all your past errors.
So you think
he's been wrong about Bitcoin?
He what?
I think Wall Street is investing in Bitcoin.
With the ETF?
I think narcos are investing in Bitcoin. Narcos. Okay, if you're holding a container in a Greek port and it's got $7 billion in $100 bills, that's hundreds of thousands of $100 bills. Are you going to want to leave it year after year after year, or are you going to want to convert it to something in the electronic age?
Yeah.
They're going to bid up I think Trump got word that Bitcoin's going to go to 100,000. You better get on board this, Donald, or you're going to look dumb. You think Donald ever wants to look dumb?
No.
He wants to look smart, and he wants to look like a stud. Okay?
So do you think Bitcoin?
Smart and stud.
You think Bitcoin is actually going to be around for good? Because there's been a lot of debate about that. A lot of folks think, certain ones like the 222 ISO coins like XLM and XRP, yes, but the prevailing consensus seems to be within the community that Bitcoin, well, I shouldn't even say that, not a consensus, but a lot of people are thinking that Bitcoin is
a lot of hubbub. There's a lot of
technology, really super slow, and it's like the brick phone, compared to the smartphone.
I don't care if it's slow. I just sold a little bit of Bitcoin and bought XRP. I thought, well, this is damn slow. I'll tell you what, I'm going to go do a quick errand and come back and see if the Bitcoin sale is done. So I came back in 15 minutes and it was done. So what?
So you think it's going to stick around as like the digital
I don't
gold
think
or
it's going to go
it?
away. Okay, there's something I learned from an Asian client of mine, super smart and managing a significant amount of money. He said, Jim, there are two major buyers of Bitcoin. One is legitimate and one is illegitimate. The legitimate one is all the Asian fund managers. And that includes the Pacific Rim. He said, Pacific Rim, Jim, it's 1 billion people, okay? You got to get wise to the Pacific Rim. We don't have an Atlantic Rim. We have a little itty bitty Caribbean, and it's got some power. But the Pacific Rim, they like sending money to Germany, to France, to Norway, to the Arab world. And they do it in Bitcoin, and it's not visible. They also use what he called all the little tokens, all the little crypto coins, where you got to stack 1,000 of them or like 400 of them to make a penny. They don't price them. So the way they describe their price is, well, you got 250 per penny. Okay, that's a few zeros and a 4. Okay, it's less than a penny, 250 per penny. I had a guy told me 2 years ago, buy Stronghold, Jim. IBM WorldWire is behind that. And if you put $1,000 into it, you're going to be a millionaire in 5 years. It went up 8-fold last year. 8-fold. And it's still a 1/12 of a penny. It used to be 100th of a penny. Okay, the point is that this Asian fund manager said that they use Bitcoin and the little tiny crypto coins to move money around.
Right.
Without the U.S. tax, what do you call it? Tax ferry. I call them the ferrymen. Hey, you're moving dollars. We want 5%. Hey, you're moving dollars. We want 3%. What gives you the right? Well, you're using dollars. So they're not using dollars. Okay. The legitimate part is that Asian fund managers and a lot of others are using it. Bitcoin. It's not going to go away. It's legitimate movement.
Really?
Now, yeah. Okay. I think 100,000.
The reason I ask, and I'll let you continue. The reason that I asked is because my understanding was that Bitcoin was essentially a black hat DARPA creation.
So is email.
Okay, but that it really wasn't going to, that it was ultimately going to be phased out, or there wasn't going to really have a place in the quantum financial system. So do you?
I think the BRICS will make sure that there is a channel and a window. I think Reggie Middleton will make sure there's a channel and a window. Bitcoin.
So how do they mitigate? Okay, so how do they? You said that there's the legitimate use of Bitcoin, and then of course you've got all the traffickers, all the dark money that's going through there. How do they address that issue if Bitcoin is going to stick around?
What makes you think that the Western banksters are going to control the QFS and all the on-ramps and off-ramps of digital finance? What makes you think that the same criminals involved with the dollar management are going to be in control of the on-ramps and off-ramps of digital finance?
So it has to do with ultimately oversight by the white hats.
What part of decentralized is escaping you? Decentralized.
Well, it's already
Decentralized.
decentralized.
I know. Well, then you can't say that for centralized reasons it's not going to be part of QFS.
Okay.
On a decentralized manner, they will get the on-ramps. They will get the off-ramps. And maybe you won't even know that they exist. Maybe they'll do it with a form of a different cryptocurrency that you don't even know about. And then suddenly it's worth 100 times more. Wow, I missed the boat on XYZ crypto. What the hell is that? By the way, that was the secret project of the on-ramp to QFS with Bitcoin. Oh, I didn't hear about that. That's exactly right. You didn't hear about that. Okay. Decentralized means decentralized, and never miss the meaning of decentralized.
Okay, well, let's break that down a little bit. So it's currently decentralized, isn't it?
Well, yeah, but you're talking about you're focusing on QFF and the 2021 or whatever it's called. So what? The decentralized forces might find a way in and have a back door, or decide later that a compromise is made for a front door. We don't know who controls the QFS. We don't know what compromises are going to be made in order to have it installed. I think the mother of invention is from the father of compromise.
You think they're going to compromise with the banksters? Is that kind of what you're saying?
Well, I think that's already been well along. I think the banksters have helped us to smash Klaus Schwab. I don't think Klaus Schwab is around.
No, I agree with you on that.
I think the Rothschilds got smashed. The Rothschilds, they got hit squads. They own the energy industry. They got banks. They've got pharmacy industry. They got the medical industry, National Institute of Health, CDC. No wonder they're the last ones. Rothschild didn't have that portfolio of control. Hey, look, the decentralized aspect of digital finance is going to be its biggest sword, and the blockchain is going to be its biggest shield. These stories about Bitcoin and the demise, they're humorous. I remember in the end of 2022 when, I think maybe the Credit Suisse story might have been 2022, not 2023, when the Russians captured a lot of Bitcoin in Ukraine underground facilities. They sold off, and we had I think it was about a 55% decline in Bitcoin. Look it up. I think it was like 57,000 down to something like 29. A real big decline. 24,000. JP Morgan came out and said Bitcoin going to zero. So how does a jackass reply to that? We just hit the bottom. JP Morgan said Bitcoin's going to zero in December of 22. I said that's the bottom. Was it the bottom? Yeah, it was the bottom. Okay, just go with these pronouncements and take a 180 twist. This is my response to Wall Street and all of your Bitcoin and crypto pronouncements. How's the SEC trials and tribulations with Ripple Tech going? Yeah. All failed. Do they have a single success? No, not one. This bird is in place, okay? Everything they say regarding crypto is wrong.
Okay, fair enough. So, well, the reason I asked the question wasn't to argue with you. It was more just to kind of get clarification, because my understanding is that once we moved in fully to the quantum financial system, which would be decentralized and actually real currency, constitutional money, gold and silver, there really would be no need for something like Bitcoin.
Well, to me, it's kind of like saying that there'd be no need for using cash to buy marijuana, to buy a hooker, or to buy a congressman, or to place a bet in the NFL.
Dear listeners, I was able to upload a portion of this interview, which lasted approximately 2 hours and 6 minutes, due to YouTube rules. You can watch it in its entirety from the link in the description. Now, some brief information about Jim Willie will be given. Dr. Jim Willie is an analyst recognized in international finance and economic circles for his distinctive viewpoints. Commonly known simply as Dr. Jim Willie, he is often said to hold a doctorate in an economics-related field, though precise details about his academic record are not widely documented. He is best known for his work shared through his website, Golden Jackass, as well as various online interviews and podcasts. His main areas of focus include fluctuations in the financial markets, central bank policies, currency trends, and particularly the future of gold and silver. A defining trait of Dr. Willie's commentary is his emphasis on precious metals, gold and silver, as critical pillars of the global monetary system. He argues that modern fiat currencies, especially the US dollar, suffer from structural problems stemming from central bank policies and the complex nature of international finance. As a result, he foresees a scenario in which the dollar weakens while gold and silver strengthen. Dr. Willie is considered by many to be an unconventional financial commentator. His analyses often diverge from mainstream economic narratives, occasionally integrating views that some label as conspiracy theories. Yet this alternative perspective has resonated with a community of followers who value his exploration of issues they believe are overlooked by mainstream media and big financial institutions. 2. The Golden Jackass platform and content structure. Dr. Willie disseminates most of his research and opinions via his personal website, Golden Jackass. The unusual name is meant to highlight his unfiltered approach. He describes himself as presenting blunt truths without fear of reprisal. Many of the articles and reports he publishes on this site revolve around major geopolitical and macroeconomic developments. Typical topics on Golden Jackass include gold and silver market analyses. Willie is known for predicting significant spikes in gold and silver prices. He argues that continuous monetary expansion by central banks will ultimately raise the value of precious metals while eroding confidence in fiat currencies. Critiques of the global dollar system. Willie believes the US dollar's status as the dominant reserve currency will eventually weaken. He often cites the efforts of countries like China and Russia in developing alternative payment systems and gold-backed arrangements. Warnings of financial crises. Willie frequently points to risks that he says mainstream economists ignore, such as the overextension of credit, large-scale derivatives, and the excessive liquidity central banks have provided since past economic downturns. Geopolitical events and their economic effects. His analysis goes beyond pure economics to examine how geopolitics impacts commodity prices, trade flows, and especially the dollar's standing in international markets. Some content on Golden Jackass is available only to subscribers. This paid model supports his independent research, which he claims allows him to investigate topics not widely covered by mainstream financial analysts. 3. Economic analysis philosophy and methods. Dr. Jim Willie's approach to economic commentary blends macroeconomic data with monetary and geopolitical factors, resulting in what many consider a heterodox style. Key aspects of his method include historical cycle analysis. He frequently references major financial crises, such as the 1929 Great Depression and the 1971 end of the gold standard, to draw parallels with current policy missteps. He views economic cycles as influenced by political and social factors, not just by raw data. Debt and credit examination. Modern finance, according to Willie, is excessively reliant on debt. He emphasizes growing global debt levels and warns that they are unsustainable. Central bank balance sheets and leveraged banking practices are frequent targets of his critiques. Comparative currency analysis. Willie tracks how key currencies, the US dollar, the euro, the Chinese yuan, and the Russian ruble, compete against each other. He underscores the role of gold reserves and potential gold backing as crucial in these contests. Geopolitical context. Willie treats diplomacy, strategic alliances, and military advantages as integral to economic outcomes. He sees global finance and politics as intertwined, asserting that a policy shift in one arena reverberates throughout the other. Reliance on alternative information sources. Willie occasionally cites unverified or non-mainstream information, claiming that official data and media may conceal the full story. Critics argue that this tendency can lead to the spread of unsubstantiated conspiracy theories. 4. Main core perspective: transformation of the monetary system. One of Dr. Willie's central theses is that the global monetary system is undergoing a profound realignment. He believes that the post-Bretton Woods world order, in which the US dollar has enjoyed near hegemonic status, is coming to an end or is on the brink of doing so. As central banks keep expanding their monetary bases, he expects rising inflation to push individuals and institutions toward tangible assets like precious metals. At the heart of this view is the idea of the coming end of the dollar or the demise of the petrodollar system. According to Willie, the following trends are evidence of this shift. Countries increasing gold reserves. Emerging markets, including China, Russia, and Turkey, have been accumulating gold, potentially to establish alternative payment frameworks involving gold. Petroleum trade in currencies other than the dollar. Willie cites China's moves to pay for oil in yuan as a direct challenge to the dollar's monopoly in global energy markets. Alternative payment systems. New networks to replace or supplement SWIFT, such as China's CIPS, could undermine the dollar's role in global trade and lessen its power as a vehicle of economic sanctions. Willie portrays these developments as gradual, with many going underreported. The eventual result, in his view, would be a breakdown of the dollar-centric system that would profoundly disrupt financial institutions and national economies, while boosting the position of gold, silver, and other real assets. 5. The role of precious metals, gold, and silver forecasts. Dr. Willie is particularly noted for his commentary on gold and silver. He argues that these metals have served as money throughout history and assumed the role of safe havens in times of crisis. While central banks can expand the money supply almost limitlessly, physical supplies of gold and silver remain finite, favoring these metals in the long run. He often alleges that gold and silver prices are manipulated or suppressed. According to this viewpoint, major banks use large volumes of paper gold, futures contracts, derivatives, to depress spot prices, as letting gold prices rise organically would highlight fiat currencies' weaknesses. Willie also applies this argument to silver, contending that silver is likewise undervalued but manipulated. Nevertheless, Willie believes that such price manipulation cannot persist indefinitely. A surge in physical demand, he argues, will sooner or later expose discrepancies in the paper market, leading to a dramatic revaluation of both gold and silver. In such a scenario, gold could rise well into the thousands of dollars per ounce, while silver might break into triple-digit territory, an outcome that could shake the entire global financial system. 6. The U.S. economy and Federal Reserve criticisms. Given that Dr. Jim Willie is primarily based in the United States, he frequently critiques the Federal Reserve Fed. He contends that the Fed's policies of quantitative easing and prolonged low interest rates have masked deeper problems while magnifying systemic risks. In his view, these policies only offer temporary fixes without addressing underlying debt and leverage issues. His key points of contention include unbacked money creation. Willie argues that the Fed's expansionary practices are disconnected from real economic productivity. Over time, such policies lead to higher inflation, even if official statistics do not fully capture it. Banking system vulnerabilities. According to Willie, large U.S. banks are more fragile than they appear due to their exposure to highly leveraged derivative products. Wealth disparity. He contends that Federal Reserve policies inflate asset markets, stocks, real estate, mainly benefiting the wealthy, while rising costs of living erode the purchasing power of lower and middle-income groups. External debt and trade imbalances. Willie points to America's escalating national debt and trade deficits, predicting they will reduce trust in U.S. Treasury bonds over time and threaten the dollar's reserve status. Willie's criticisms draw from independent research and alternative media sources, which he sees as less prone to presenting sanitized official narratives. While his supporters view him as exposing underreported truths, critics accuse him of selective data usage or undue alarmism. 7. Geopolitical analyses. East-West economic rivalry. Dr. Jim Willie incorporates a geopolitical lens into much of his economic commentary. He posits that the world's financial and political power is shifting from Western nations, particularly the United States and the European Union, toward Eastern powers like China and Russia. This shift, in Willie's view, involves energy resources, major trade corridors, and the struggle for technological advantage. Key points he often raises include the Belt and Road Initiative. Willie believes China's massive infrastructure project will reshape global trade routes, reduce reliance on the dollar, and accelerate Eurasian economic growth. Gold-backed currency deals. He speculates about the possibility of China and Russia jointly introducing a gold-backed digital currency or forming a trade bloc that circumvents the dollar. Energy wars. Willie states that which currencies are used to settle oil and natural gas contracts is vital. If Russia shifts to selling energy in rubles or yuan, or in exchange for gold, he sees this as a direct threat to the petrodollar system. Diplomatic and military tensions. He asserts that international tensions and conflicts can hasten financial decoupling, leading to regional economic blocs and alternative payment networks that erode the dollar's reach. Willie often cites Russian, Chinese, or other non-Western media sources to bolster his arguments, which tend to frame developments as part of a broader East-West struggle. While mainstream sources may find these views too stark or speculative, Willie's supporters regard them as a clearer portrayal of how global power balances are evolving. 8. Supporters and critics. In the realm of economics and finance, Dr. Jim Willie is considered an alternative analyst rather than part of the mainstream. This status has earned him a committed following while also drawing criticism from established economists. Supporters. Belief in exposé of hidden realities. They see Willie's commentary as a revelation of financial manipulations overlooked by mainstream channels. Precious metals enthusiasts. Investors bullish on gold and silver tend to resonate with Willie's stance on the eventual surge in precious metal values. Those interested in conspiracy theories. Willie's emphasis on secret deals and under-the-radar developments appeals to people who suspect official narratives are incomplete. Critics. Accusations of excessive speculation. Critics argue that many of Willie's forecasts have either failed to materialize or lack solid backing. Disconnected from market realities. Some economists see Willie's views as too extreme, diverging significantly from conventional market indicators. Promotion of conspiracy theories. Central to their critique is that Willie relies heavily on data or rumors that mainstream economics deem unverified. Dr. Jim Willie often counters these critiques by stating that time will prove him right. His followers tend to regard short-term inaccuracies as less important than the larger, long-term trends he highlights. 9. Major themes in publications and interviews. Dr. Jim Willie appears regularly on podcasts, in online interviews, and through articles in which he reasserts or refines his views about global finance. Recurring themes include monetary policies and the prospect of inevitable collapse. Willie often labels the ongoing wave of central bank easing as unsustainable and believes it will lead to an unprecedented debt bubble. Global trade and the dollar's standing. He focuses on the likelihood of the dollar losing its primacy in oil transactions. In his view, geopolitical powerhouses like China and Russia are accelerating this shift. Manipulation in metal markets. According to Willie, the only reason gold and silver are not trading at much higher levels is price suppression, which he believes will eventually fail. Investment suggestions. While stopping short of giving direct investment advice, Willie regularly emphasizes the value of holding physical gold and silver. He sometimes comments on real estate, cryptocurrencies, or other commodities, but his primary stance remains consistent. Tangible assets are a hedge against potential financial turmoil. 10. Dr. Jim Willie's forecasts and their accuracy. Like many financial commentators, Dr. Jim Willie has made various predictions over the years. While some have aligned partially with real outcomes, others have not materialized according to his expected timelines. Critics highlight inaccurate or postponed forecasts, especially concerning the swift collapse of the dollar or hyperinflation that did not occur as predicted. Willie and his followers attribute such delays to factors like ongoing market manipulation or new geopolitical agreements that slowed down the anticipated shifts. They also stress that his analyses revolve more around long-term structural issues than short-term market timing, and that certain economic events might simply be unfolding later than initially expected. At the same time, supporters note that Willie accurately pointed out the continued expansion of central bank balance sheets and the trend of countries accumulating gold reserves. Whether these represent unique insights or broader trends also recognized by mainstream analysts is open to debate. 11. Conspiracy theories and critiques of mainstream economics. Dr. Jim Willie sometimes embraces viewpoints described as conspiracy theories, such as allegations of covert arrangements among global banking elites or claims that certain financial institutions deliberately engineer crises. These comments often lack direct support in official reports or academic literature, undermining their acceptance by mainstream experts. Nevertheless, Willie's core audience contends that the very absence of this information in major news outlets is evidence of systematic cover-ups. This tension results in a polarized reception. While some commend him for tackling subjects that major economists avoid, others dismiss his arguments as relying on rumor or anecdotal evidence. 12. Building an audience and media strategy. Dr. Jim Willie's influence stems in large part from digital media. Rather than appearing frequently on television networks or in major newspapers, he has cultivated a following through his website, Golden Jackass. The subscription-based model allows him to finance his research and post in-depth analyses without relying on traditional editorial norms. Podcasts and interviews. Alternative finance channels invite him to discuss his views, giving him a platform free from mainstream editorial constraints. Social media. Willie uses social media platforms to share shorter commentaries and link to his more extensive articles or interviews. This approach targets a niche yet dedicated audience, particularly those skeptical of mainstream financial narratives. Willie's unconventional or controversial theories find an environment of fewer restrictions online, aligning with audiences seeking alternative takes on global economics. 13. Dr. Jim Willie's place in the financial world. In mainstream banking circles or academia, Dr. Jim Willie is not widely cited. Instead, he operates as an independent commentator, an outsider who both intrigues and polarizes observers. Critics consider his warnings overly dire and his reliance on unofficial data problematic. But the financial turmoil of previous crises has also made many investors more open to unconventional perspectives. Those who value his work stress how events like the 2008 financial crisis validated skepticism toward institutional analyses. Willie's arguments about the unsustainability of constant monetary easing and the precarious nature of the global debt burden echo broader concerns, though he often frames them more bluntly. Overall, Dr. Jim Willie sits at the intersection of alternative finance commentary and mainstream critique. While he has a loyal core following, he is also subject to ongoing scrutiny by economists and analysts who question his methods and conclusions. 14. Conclusion and assessment. Dr. Jim Willie stands out in alternative finance circles through his strong critiques of central banks, fervent support for gold and silver, and emphasis on significant geopolitical realignments. His central premise is that the current global financial order, especially the dollar-based system, is unsustainable. According to Willie, ever-increasing debt and persistent market manipulation will eventually trigger a major monetary crisis, one in which holders of real assets, particularly precious metals, will thrive. Yet, questions remain as to whether his most dramatic predictions will unfold precisely as he envisions, and on what timeline. His track record has been mixed, and skepticism about certain forecasts lingers. Supporters respond by emphasizing that Willie's perspective is best understood as a warning about underlying fragilities that may require more time to materialize or that might manifest in ways not easily predicted. Regardless of these debates, Dr. Jim Willie has established a definite niche. His analyses, whether embraced or doubted, compel audiences to consider alternative possibilities and deeper layers of the global financial system. For that reason, those who engage with Willie's writings often do so with a blend of caution and curiosity, recognizing that while his approach can veer into unconventional territory, it may also provide a valuable counterpoint to mainstream narratives.
Don't forget to like our video and subscribe for our channel.